Welcome to TaxLawGH and welcome to our next video in the series on the taxation of petroleum operations. In this video, we continue from where we left off in the second part, and let's look at still the provisions on deductions for petroleum operations. So first thing you must know is we are saying that for the purpose of applying section 14, which deals with capital allowances, we are saying that written down value of a pool of depreciable assets means the written down value of all assets in that pool as determined by the third schedule, and any excess expenditure that relates to section 12.3, which deals with repairs and improvement expenditure, shall be added to that pool for the year in which the expense is incurred. Now, a number of things for you to remember here. Both things I just mentioned have been covered in different videos, but let me help you out. It's possible you've forgotten, it's possible you've not watched. So the first bullet talks about capital allowances. In summary, we have a video that covers capital allowances. Watch part 3 of the capital allowance series. It talks about taxation or the capital allowance rules for petroleum operations. But for your purpose or for your benefits today, know that petroleum operations are subject to capital allowance at a rate of 20% on a straight line basis. So you put all their assets in one big pool. They don't do the general pooling system that other entities do. They put all their assets into one big pool, 20% capital allowance, and that's what they get. Also, if you've forgotten, under the business and company income tax series, we looked at a special rule for repairs and improvement. If you've forgotten, I've reproduced it on the right. Section 12 sub 2 said a deduction granted for a year of assessment with respect to a depreciable asset in a particular pool of depreciable assets of a person shall not exceed 5% of the written down value of the pool at the end of the year. This is something you should know. If you're watching this, I expect you to know this, but if you've forgotten, it's fine. Just remember that for repairs and improvement expenditure incurred, the law has given a threshold that says that deduction for repairs and improvements will not exceed 5% of the written down value of that particular pool to which that asset belongs at the end of the year. Any excess expenditure above the 5% pool is supposed to be added to the pool, and then capital allowance will be granted on that excess expenditure as well. So we are saying that any excess expenditure here is required to also be added to the pool of assets to which the expense is incurred. So here, all we are saying is that petroleum operations also follow the rule for repairs and improvement, that 5% limit. That's all we are saying here. But just know that for them, they have one big pool for all the assets. So if it's repairs for whatever assets, to all go into that same one big pool, you get 20% straight line basis. We are saying also that in ascertaining the income of a person from a separate petroleum operation for a year of assessment, relevant financial costs incurred during the year may be deducted only to the extent that relevant financial gains are included in calculating that income. Now, once again, if you watch the video on business and company income tax, we spoke about the rules in section 16 on the limits on deduction of financial costs, which had an interesting scenario that said that when it comes to determining the applicable deduction or how much you can deduct for finance costs, there is a limit which says that they shall not exceed a certain threshold. So if you do not meet that threshold, we said that any excess expenditure will be deferred or carried forward for the subsequent 5 years. We are saying that without limiting section 16, a person may set off a loss in respect of a financial instrument against a gain. But what must you take away from here? If you observe, we are using the term relevant financial cost and relevant financial gain. And at section 16, we did not mention relevant financial cost and relevant financial gain. So, to not complicate things, to not confuse you at this point, just know that petroleum operations rely on something called relevant financial cost, relevant financial gains. Whereas general businesses will use finance cost, finance gain. The law defines them differently. So just keep a note of this. When we do advanced income tax concept, we will break these two apart separately and you get to know the difference. But for now, make a mental note that petroleum operations use relevant financial costs. General businesses use finance cost for their limitation. What else must we know? Still under deductions, we are saying here that a finance cost for which a deduction is not available may be carried forward by that person and treated as incurred during any of the next 5 years. This is the same rule under section 16 of the income tax that other businesses get. We are saying where a person carries forward the finance cost under the above, that cost shall be deducted by that person from the income in the order in which the cost was incurred. Nothing new here, same principle for all other businesses. Then, what is new is what I'm going to talk about here. Where there is a change in ownership of an entity in the manner referred to in section 62, then a carry forward of finance cost is subject to section 62. What does section 62 say? It deals with the change in ownership. If you look on the right, 62 says where the underlying ownership of an entity changes by more than 50% at any time within a period of 3 years, the assets and liabilities of that entity immediately before the change is deemed to be realized. So this is something we call change of control, or that will lead to something called the COC tax or change of control tax. So where a business's underlying ownership changes, let's say at the top, there's a change in who owns what, and the change is by more than 50%, then we deem, and that change occurs within a period of 3 years, we deem the assets and liabilities of that business before the change to have been realized. So whether or not there was an actual sale, we deem, it's called a deemed realization. We assume that you've sold your assets and you need to pay tax on any gains you made on the disposal. So just take note that there's something called change underlying ownership. It will be the subject of a separate video, but just be aware of this if you don't know it yet. Now we are saying subject to that, where there's a change in the manner I just spoke about, more than 50% of underlying ownership, then any carry forward of finance cost we just mentioned will be subject to 62. 62 has special rules on carry forward of finance costs. You can't carry forward pre and post and all of that. So we deem the period before and after the change to be separate periods, and you cannot cross over when it comes to some of these things. Just know at a high level. Also, subject to the rules on section 65, where we spoke about being able to carry forward the exploration and development cost from year to year until a certain year when you commence production and can capitalize, yes, that provision. We are saying that subject to those rules and for the purpose of granting a capital allowance, the cost of a depreciable asset with respect to a separate petroleum operation includes a number of things. The cost of a petroleum right and the balance in the pool of exploration development expenditure at the time production commences. Remember I said when production commences, you accumulate all your exploration development costs so far and you grant capital allowance. So they're just reiterating here that when it comes to finding the balance in your pool of depreciable assets, you need to also include all of the exploration development expenses and also the cost of any petroleum rights. Still on deductions, a lot to know here. Any expenditure incurred in developing petroleum operations and infrastructure, including expenditure which is capitalized in accordance with generally accepted accounting principles and that does not otherwise qualify to be included in the cost of an asset, will be subject to its own separate rules as well. Also, any bonus payments made in respect of the grant of a petroleum right will not be given deductions as well. Then the minister may, by legislative instruments, make regulations to prescribe other deductions that may be allowed or may be disallowed. So these are a lot of things to take in when it comes to deductions concerning petroleum operations. You can see the rules for deductions are very, 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 very numerous. There are lots of rules to know when it comes to deductions. You can see income was shorter. Now we've looked at a lot of deductions. How do we define losses, or how do we treat losses from petroleum operations? If you remember, we spoke about section 17, which dealt with losses, and we spoke about the income tax regulations, LI 2244's rules, also about deductions. Not to bore you with the technical details, if you watch the video on business and company income tax, we said that in the general or the high level, we have two types of loss carry forward provisions. We said businesses in the priority sector can carry forward losses for how many years? 5 years. Businesses in the non-priority sector can carry forward losses for how many years? 3 years. If you remember, when I gave you the list of businesses that were in the priority sector, we placed petroleum operations in that list. So it means that all we are saying on this slide is that petroleum operations will be able to carry forward unrelieved losses for a period of 5 years. That's all. So here, I'm saying that the provisions of section 17 applies to unrelieved losses of a person from a separate petroleum operation subject to the following: that the unrelieved loss shall be deducted by that person in the order in which it was incurred, which is what we learned when we were doing loss carry forward. And any unrelieved loss from a separate petroleum operation may be deducted by that person only in calculating future income from that separate petroleum operation and not income from any other activity. So, for example, if you own 3 oil blocks, you cannot use losses incurred in oil block A to offset income from oil block B or oil block C. We are doing strict ring fencing. You must carry forward losses for a separate petroleum operation to apply to income of that particular separate petroleum operation. So you can't cross over. Everything must stay ring fenced. Everything must stay within the oil block, the separate petroleum operation to which you have a separate petroleum right. Remember this provision on losses. What are the rules around disposal of petroleum rights? Remember I told you petroleum rights will be what will give you the right to undertake what petroleum activity or petroleum operations with respect to a particular oil field or oil block. Now, if for some reason you are tired of oil and gas, you want to dispose of your rights to someone else, you want to exit the industry, if you sell your rights, you can make a gain, right? You can make a loss. Now, where a person holds a direct or indirect interest in an entity that holds a petroleum right, the person is treated as holding the interest as a capital asset employed in the business of an entity. So just know that the law is deeming petroleum rights as what? Capital assets and not depreciable assets and not investment assets. Let's just be clear here. So where the underlying ownership of an entity that holds a petroleum right changes by more than 5%, by 5% or more, the entity is considered to have disposed of a proportionate interest in its petroleum rights and immediately reacquired that interest by incurring an expenditure that is equal to the amount received for the right to dispose of and receive for the disposal consideration equal to the amount received or receivable as consideration that has arisen out of the change in ownership or the market value of the proportion of the right to dispose of, whichever is higher. What does all this mean? If you remember, when we're talking about finance costs not too long ago, we said the limitations around finance costs will be subject to the rules around Section 62, which talks about change in ownership. But when it comes to petroleum rights, it is not 50% that will trigger a change in or the underlying ownership being deemed as changed. It is just 5%. So where an entity holds a petroleum right and the underlying ownership of that entity changes by just 5% or more, this can be just a small transaction. You sell your shares to someone, someone acquires you, just 5% change. We are saying the entity will be considered to have disposed of a proportionate interest of their petroleum right, and immediately they bought it back or they reacquired that interest by incurring an expenditure equal to that amount, and they will be deemed to have received for the disposal also consideration. What would the consideration value be? It will be the higher of two things. The higher of what? One, any amount you received as consideration that's arisen from the change in ownership, or the market value of the proportion of the right disposed of. So remember that for petroleum operations, where there's change in underlying ownership by 5% or more, we deem the petroleum right to have been disposed of. And if it has been deemed as disposed of, then there will be tax consequences. So another examinable area, just note that for petroleum operations, be looking out for 5% change to determine whether there has been a trigger for change in control computation for any gain or loss on the disposal of a petroleum right. Remember, 5% threshold. Also, where the ownership of an entity changes in the manner we just spoke about, the entity is required to notify the Commissioner General within 30 days from the date of the change. So remember, petroleum operations, your underlying ownership changes by 5% or more, you have 30 days to notify the Commissioner General of this change. If you fail to comply with the above, which is notification within 30 days of a 5% or more change, you are deemed to have committed an offense and you'll be liable on summary conviction to a fine of not more than 200 penalty units, which will translate to roughly 2,400 cedis for each failure. So remember that you must notify the Commissioner General within 30 days of undergoing a 5% or more change in underlying ownership that relates to a petroleum right. If you fail, you have a penalty to pay. We're saying this or these rules does not affect the tax treatment of actual disposal of petroleum rights. So this is where you actually sell the rights. There's a gain or loss, you pay tax on. Remember when we're doing income from petroleum operation, we said any gain you make on the disposal of the petroleum right must be added towards your income. We are saying that this, all we are discussing here about this 5% deemed change, and whatever, does not affect the actual tax treatment of real disposals, separate provision, right? And it doesn't affect the application of section 62 to an entity that holds a petroleum right. So yes, you may hold a right, but if your own underlying ownership changes, it doesn't mean you are exempt from 62's provision. So just mean that the 5% is for petroleum rights or holders of petroleum rights, but it doesn't mean that once you are engaged in this business, you are kind of exempt from the rules of 62, which is the general 50% underlying ownership change. Remember this as well. Let's talk about decommissioning funds, which I have spoken about in a previous video, but now this is the time for it. Remember, I just said a decommissioning fund. Let's even use the definition on the right for clarity's sake. I'm saying it means a fund established by a contractor of a petroleum agreement in accordance with an approved decommissioning plan. So we are saying any fund that a contractor establishes under a petroleum agreement in accordance with an approved decommissioning fund or decommissioning plan is called a decommissioning fund. What is an approved decommissioning plan? Let's look at that up there. As in, it means a plan approved by the minister responsible for petroleum for decommissioning the facilities used in petroleum operations upon cessation of those operations. Remember, I told you that when you cease oil and gas operations, any harm you may have done, any machines you need to remove, any equipment you need to dismantle, you might have put money aside to undertake those activities. Now, a decommissioning fund, like I said, is a fund in which you make periodic payments. It can be a series of annuity payments on a periodic basis, such that when it's time to do decommissioning, you have enough money to undertake those activities, right? So what are the rules for decommissioning fund? I've seen an amount accumulated in or withdrawn from a decommissioning fund for decommissioning purposes is exempt from tax. So that fund you are contributing into, any amount you withdraw from it or any amount that is in that fund is exempt from tax. If you remember, when we're talking about deductions in the previous video, what did I say? That contributions to a decommissioning fund were allowable deductions. At the same time, any excess expenditure incurred if you did not have enough money in your decommissioning fund, if you spent any extra money to do decommissioning, that extra expenditure was also deductible. In the same vein, if after decommissioning you had a surplus balance in a decommissioning fund, what did we say? We said the surplus balance will also go into determine your income and will tax you on that surplus, right? So once again, let's establish where there is a surplus in the relevant decommissioning fund. After a person completes decommissioning of a separate petroleum operation conducted by that person, or at the time the person breaches an approved decommissioning plan, that surplus shall be included in calculating the income of that person from the separate petroleum operation for that year. Same principle we've spoken about under income from petroleum operations. So just note very brief provisions around a decommissioning fund. What are the rules when it comes to withholding tax for petroleum operations? We are saying here too, very interesting provision. If you remember when we were doing business and company income tax, we spoke about a certain exemption for dividend payments and the taxation of shareholders. So we are saying that that rule will not apply to dividends paid by a company that is into petroleum operations. What did we see? If you've forgotten, let me give you a refresher. If you look on the right, we are seeing a dividend paid to a resident company by another resident company. It's exempt from tax, where the company that received the dividend controls indirectly or directly at least 25% of the voting power of the company which paid the dividend. So, if you are a company, you have shares in another company, and that company pays you dividend, and you hold 25% or more of the voting power of that company, generally, you are exempt from the 8% dividend withholding tax. We are saying that that rule applies to everybody but petroleum operations. So we are saying that if you look here, section 59.3, which I just read on the right, does not apply to a dividend that you pay or paid by a company that conducts petroleum operations or that has in the past conducted petroleum operations, or a company that is a partner in a partnership that conducts petroleum operations or that has conducted petroleum operations. A dividend paid in the circumstances where the above applies is subject to withholding tax in accordance with the law, which is 8%. So remember that the 25% or more voting power ownership that exempts other companies from withholding tax does not apply to petroleum operations. So once again, examiners love this area. They'll give you a nice scenario. They'll tell you the company owns 30% or more. If you don't read the question carefully to see that it's a petroleum operation, you might say that the exemption applies, but no. These petroleum operation guys, you can even own 100%, own 99%. You will still be liable to the 8% dividend withholding tax. Remember this. Let's talk about the rules for expatriate employees or foreigners you bring to work as part of your petroleum operation. What are the rules for them? They're saying without prejudice to the provisions of a petroleum agreement, the gains or profit of an expatriate employee who is employed by a contractor or a subcontractor who conducts petroleum operations exclusively is liable to tax and withholding tax under this act. This is the first time we've seen the term subcontractor, so let me explain. Remember I told you the contractor is the main guy, the main player who comes to sign the petroleum agreement with the government of Ghana, who wants to drill oil in Ghana. Now remember that the contractor may need other service providers to do their work. They cannot do everything themselves. So if the contractor also enters into another contract with someone else to help them as part of their oil and gas operations, then that person is deemed as a subcontractor. So think about service operators. If they need someone to help maintain the rig, to do repairs from time to time, then when they pay that company or they enter into a contract with that company to help them facilitate repairs, help clean the vessel, the drilling vessel, even provide catering services on the vessel, bring food to the offshore staff. All of these people are deemed as subcontractors. Why? Because we have the main contractor and he has given a subcontract to someone to help with them, right? So we're saying that the employees who are employed by either the contractor himself or his subcontractors and they conduct petroleum operations, they'll be liable to tax under the income tax act. But don't forget that's why I say petroleum agreements are king, because some petroleum agreements exempt some persons for a number of days. For some it's 30 days, we also have 60 days. So for a certain period of time, some employees may be exempt from the provisions of income tax. So read the specific petroleum agreements that pertains to that particular petroleum area or petroleum operation before you conclude. That's why the law says that without prejudice to that agreement, then expat employees are what? Taxable, or they are liable to what? Tax and withholding tax under the act. So remember that the petroleum agreement will reign supreme over this provision. So take note, they will be exempt within a certain period of time. Some even have exemption from contributing to social security schemes in Ghana and all of that. It is based on what? Provisions of petroleum agreement by petroleum agreement. Who is an expatriate employee? It means anyone who is not a citizen of Ghana and who is employed for or in connection with the conduct of petroleum operations by a contractor or a subcontractor under an express or implied contract of employment which provides for the passage to and from the country and in respect of whom an approval has been obtained from the Ghana Immigration Service. So long definition, but these are who we deem as expats. Remember that all we are saying here is that expat employees are subject to tax under the Income Tax Act unless the petroleum agreement has given them a special treatment, in which case the petroleum agreement will override the rules of the Income Tax Act. Let's talk about withholding tax in general. We are saying that where under the terms of a contract an amount is due to a subcontractor, which I just explained. These are people the contractor engages to help them do different things when it comes to the oil and gas operation they are involved in. In respect of works or services for or in connection with the petroleum agreement, the person liable under the contract to make payment to the subcontractor shall withhold tax at the rate specified in the fare schedule and will pay the amount of tax withheld to the Commissioner General. What are the rates? If you have watched our video on withholding taxes, you would have learned this rate. If you've forgotten, it's fine. Look on the right. If you make a payment to a resident subcontractor, you withhold tax at 7.5%. If you make payment to a non-resident subcontractor, you withhold at what? 15%. We are saying that tax withheld in the case of a non-resident person is the final tax. So it means that tax to, or the tax withheld to payments, or tax withheld on payments to a resident subcontractor will be a tax on account, whereas payments to a non-resident subcontractor will be deemed as a final tax. What else must we know? You must furnish quarterly returns of income with the Commissioner General. So a person who is engaged in a petroleum operation shall, not later than 30 days after the end of a quarterly period, furnish the Commissioner General with a return containing an estimate of the chargeable income of that person resulting from the operations during that quarterly period, and also an estimate of the tax due on the chargeable income of the person, and a remittance, a payment in settlement of the estimated tax. Remember that petroleum operations have a quarterly return to file. They must do it not later than 30 days after the end of a quarter, and they must furnish the Commissioner General with the return, with an estimate, and then they must pay any tax due on their estimate. So this is an extra obligation for petroleum operations. What else must you know? Aside the quarterly one, they also have annual returns to file. So this is in line with like the general one that everybody files anyways, but they have some specific things to also add. So a person who is engaged in a petroleum operation shall, not later than 4 months after the end of the year of assessment, furnish the Commissioner General with a return for each separate petroleum operation for a year of assessment. So once again, if you own multiple oil blocks, separate return for each oil block. That's what we mean over here. The annual return must include a number of things. It must include a statement containing the full names, addresses, nationality, salaries, wages, fees, and allowances of the persons employed in the country. So here's not just not a return that talks about what you earned and how much tax you must pay. You must have other disclosures. All persons you have employed as part of your operation, their full names, their addresses, nationality, salaries, wages, fees, allowances. A statement of the amount of production during the year of assessment and the share of that person in that production. So how much oil and gas did you produce? How much petroleum did you produce? And what is your share in that production? And don't forget that when it comes to the share, the petroleum agreement will give information about this. A statement of the price you paid for the sale or export without sale of the person's share of petroleum. So give us a detailed explanation or a detailed statement of the price at which you valued your petroleum at each particular point where you either sold or you exported without selling your petroleum from the petroleum derived or petroleum operations for the year. Then any information relating to matters referred to that is provided under the petroleum agreement. So anything the law has spoken about or we've discussed over these videos that will be required by law, you also need to disclose. Finally, any other statement or information that's required under the Income Tax Act, you must also disclose on this return as well. What else should you know? We are saying that where there's a dispute regarding the price, remember we said you must disclose the price at which you sold your petroleum, right? So where there's a dispute regarding what the price is in respect of your share of petroleum, we are saying the chargeable income of that person shall be calculated on the basis of the price proposed by that person. So we are saying that no worries, we don't know, you are arguing with GRA what the price should be. Maybe you are saying it should be X dollars, they are saying it should be Y dollars. I say no problem. We'll calculate your chargeable income in accordance with the price you are proposing, right? We'll go with yours. But there is a but. We are saying where a final determination of the price is made in accordance with the terms of the petroleum agreement, the person shall now submit a fresh return. Don't forget that we said where there's a dispute in pricing, we'll go with yours. We'll use that to determine your tax payable. However, when we finally determine the price, you are required to submit fresh returns. In these fresh returns or new returns, you have to indicate the determined price. You need to indicate any adjustment required to be made on account of the determined price. So if you need to pay more taxes, let us know the adjustment. If we need to refund, let us know. And any tax due where applicable. Then these fresh returns must be submitted within 30 days after we finally determine what the actual price should be. after we determine what the actual price should be. Then the Commissioner General has the power to request for additional information. So we are saying where the Commissioner General thinks necessary, he can give you notice in writing if you are engaged in petroleum operations and require you to furnish within the time he mentioned in that notice further information as to the matters in connection with your quarterly returns and your annual returns. So you can say, I feel you didn't give me information on this particular thing, or why didn't you furnish me with this information? I want this information within a certain period, 2 months, 3 months, 30 days. He will let you know and you must comply. Or any matter which he considers necessary for determining your assessment. So he can write to you at any time and ask you to provide him with any information within any period of time he determines. That's what we are saying over here. Then let's talk about payment of tax by quarterly installment for petroleum operations. We are saying that tax for a quarterly period, which I just spoke about, is due and is payable 30 days after the end of the quarter to which the tax relates. We've spoken about this already, but it's just a way to reiterate the requirement for petroleum operations. So by way of basics, and when I say basic, very basics of petroleum operations taxation or income taxation for petroleum operations, let's end it all here. The next time we pick up petroleum operations, we'll be delving into the very complicated areas, so come prepared, but you love it. So let's end here, let's pause here. If you love this video, don't forget to smash the like button and don't forget to share this video within your entire network. I'll catch you in our next video.